Welcome to this month's Third Thursday webinar, brought to you by Synergy Settlement Services. The Third Thursday webinar is part of an ongoing free monthly webinar series. Each presentation is done by a Synergy subject matter expert who will tackle difficult issues that arise at settlement. During today's presentation, if you have questions, type them into the control panel where it says Questions. The following brief presentation will give you an overview of what Synergy does in 30 seconds.
A trial lawyer's job isn't to know all the nuances, to know what it takes to keep Medicaid in place or SSI and preserve Medicare and comply with the Medicare Secondary Payer Act and resolve these complicated liens that may be present. So all of those issues are issues that the trial lawyer really doesn't have the time or the expertise to deal with. They need a partner that they can rely upon that can handle all of those issues, and that's exactly what Synergy is.
Welcome to the Third Thursday webinar series. Synergy Settlement Services provides these webinars each month. We hope you enjoy this session on attorney fee deferrals. Stay in the loop with us as each month we provide more and more valuable and useful tips on hot topics in the settlement industry. Everything we do at Synergy is designed to help attorneys, their firms, and the families they serve. We work directly with attorneys to help them defer fees into future years. We help them provide lien resolution for their clients. We offer healthcare, Medicare, Medicaid, and various types of lien resolution programs. We handle all types of Medicare compliance, including Medicare set-asides. We also work with the families directly to provide settlement planning and consulting and also discuss trust solutions with them. In today's webinar, we're going to discuss attorney fee deferrals. Oftentimes, you spend hundreds or even thousands of hours on a case creating value for your clients. However, at the end of that case, attorneys miss the unique opportunity they have to defer taxation on their fees in the current year and push that into future years. So what we want to discuss and remind everybody is to not forget about yourself when you're doing your planning. Planning ahead is the most critical part of starting an attorney fee deferral program. It will allow you to match your wants and needs with the products and services that are available to you. I'm going to start the presentation with a couple of quotes from people that are a lot smarter than me. Plans are nothing. Planning is everything. Dwight D. Eisenhower. Success is the residue of planning. Benjamin Franklin. I truly hope that you take away from this the idea that you need to plan ahead, and by doing so, you can create great value by deferring your fees into future years. I wanted to give you a quick agenda on what we'll be going through today. I'm going to start with the basics and give you an overview of attorney fee deferrals. I will hit on the major types of plans that are in place. I'll go through the benefits and limitations of each of those products and services. I have a couple of financial examples and some industry statistics, and I'll also discuss with you the ways to get started in the programs. I'm going to follow and end the session with a questions and answer piece, so feel free to get your questions ready. Let's start with the real basics. What is an attorney fee deferral program? What it essentially means is that you can take all or part of a fee on a case and defer the income in that year into a future year or years. This will hopefully allow you to pay a lower tax rate and avoid paying the highest tax rate in the current calendar year if you've already reached those limits. Trial lawyers are in a unique place that they have the ability to do this, whereas most of us do not. Why do attorneys have access to this? In 1994, Childs versus Commissioner, the IRS tested this program. What resulted is a private letter ruling, and you can see it cited here, but it's PLR-150850-07. And essentially, it states that attorney fees resulting from a case involving physical injury or physical sickness can be paid as periodic payments. You're able to take your current year fee, so a fee you earned in 2021, and defer it into future years as periodic payments and pay taxes in those years. So a fee earned in 2021 can be deferred to 2022, 2023, 2024, and paid in the years the actual fee is received. Some more of the basics of the program. It's really important to realize that you can defer all or part of a fee. You do not have to defer the entire fee. You are allowed to, but you do not have to. When you defer the fee, the income tax is deferred. So the income and tax are deferred until the calendar year in which you actually receive those payments. There's no cap on the amount that you can defer during a calendar year, and there are no early withdrawal penalties like in other retirement plans. Let's compare an attorney fee deferral with your more traditional plans like a 401k plan. On the similar side, both plans allow you to take income that you're receiving in a current year and defer it into future years. The main differences are listed here. With an attorney fee deferral program, there are no contribution limits, meaning you can defer over $1 million into an attorney fee deferral program. With a traditional 401k, typically that limit is topped around $25,000 based on the IRS's rules that year, and you cannot defer over that amount. In addition, on the receiving side of the funds, most retirement plans have got an early distribution penalty on funds received before 59.5. We have clients as young as 30 defer into attorney fee deferral programs and helps wedge that gap between 50 to 59.5 so that they have access to fees they deferred, but also do not have to pay an additional penalty to take those prior to that year. There are no matching or requirements to fund employee or partner accounts. This is something that an attorney can do as a standalone program for themselves. There's also no ERISA compliance. There's no testing. There's no compliance issues that make you defer into other accounts if you defer into your own. Today, I'm going to hit on the two main categories of attorney fee deferral programs. Each category has got various providers that you can utilize to diversify your risk. The first one is a traditional structured settlement annuity. This is the first way that attorneys were able to defer their fee. In a traditional structured settlement, you defer your fee into a fixed annuity product. The fixed annuity will pay you periodic payments that are outlined in the release and qualified assignment. Those payments are fixed and determinable. The only way you have a payment that actually will adjust is through cost of living adjustments. So you can create some increases in monthly or annual payments. You can also utilize a rider that will allow for indexed equity crediting. That will allow you to have some market-based cost of living adjustments. The second main category is essentially a deferred compensation assignment. In those programs, they utilize various investment choices. They have various costs, and there's different ways that the fee is deferred on the front end. The investment options range from a money market all the way to equities. Let's talk about some of the pros, benefits, and the limitations and/or risks of a traditional structured settlement attorney fee deferral. The benefits are you can create a fixed and determinable payment schedule so you know exactly what you're getting and when you're getting it. The payments are backed by very highly rated insurance companies, limiting your risk. There is no actual market risk. There are no ongoing fees or costs associated with the programs. There is typically no setup fee. You can also set up a payment that is guaranteed for your lifetime, meaning you cannot outlive that payment. Some of the limitations and risks of the programs are you do have an interest rate risk, meaning the interest rate that you start with is typically the interest rate you're set with the entire time. So if interest rates go up, you may be in a lower interest rate in your contract. The timing of payments is set and cannot be changed, meaning if your plan changes personally, you cannot change when those payments from the structured settlement annuity come to you. You have company risk in that you are going to be placing the funds in an insurance company. If something happens to that insurance company, that is a risk that's associated with this program. And there is no flexibility at all after you set it up. Sort of like we talked about with timing. The amount of money that goes in is only going to come out based on how it's listed in that periodic payment schedule. Just like in the slide before, I'm speaking in general terms on the program. So in the slide before, different insurance companies will have similar types of benefits and limitations. In the deferred compensation programs, it's very similar. Most of the benefits are the same and most of the limitations and risks are the same. So you'll want to talk to all of the different providers. The benefits are they do provide fixed percentage schedules of when the money's coming out and the percentage that you're going to receive. They typically have a wide variety of investment options, and if you search all of them, you're going to find almost anything that you can conceive. There are multiple providers in the space, so you can actually weigh the pros and cons of each one of the providers. It provides you with investment flexibility from a money market up to an equity. And the distribution schedule has a little bit of flexibility in it, meaning you can make some future deferrals on fees that are set to come due. The limitations or the risks of these programs are a little bit different. They do have ongoing fees and expenses, so each year you're typically charged a management type fee or a trustee fee. The arrangement is a lot more complex than your traditional structured settlement. Same risk in terms of company. Each one of these is an individual company that is sponsoring the program. They typically do not have lifetime guarantees at a fixed rate. And there's market risk. The investments that you ultimately choose in there can go up or down. In keeping with the theme of this presentation, I want to keep these examples as broad as I can, meaning they work for both types of products and services that we've talked about. But essentially what happens is, in this example, if you've got a $100,000 fee and you invest that fee after you pay tax, you can see your fee goes from $100,000 down to a net investable fee of $61,000, meaning you've got 39% less money working for you in whatever product you decide. So if you were to do a structured settlement annuity inside the plan, $100,000 would be invested for you. If you took your fee, pay taxes at a 39% federal and state tax rate, I know that varies between state and federal programs that you're in, but just to give you an idea, we went with the 39%. If you did the same exact thing, paid your taxes, and bought the same annuity, so the exact same fixed annuity schedule, the net investable would be $61,000, meaning you really have 39% less money working for you day over day. I kept the numbers the same as the previous slide, meaning $100,000 as the fee, a 39% tax rate. You can see more what that reduction in investable assets means to you. So in this scenario, if it's fully taxed and you take $61,000 and return 7% on it, the actual funds and increase in value would be $4,270. In the same scenario, if you take $100,000 and defer the full amount and earn the 7%, your return is $7,000. So you can see what less money working for you with the same return means. It means a higher account value for you as you pay less tax and invest more. I have been in this space for over 20 years now, and one of the things that I can't figure out is a disconnect between the marketplace and the amount of attorneys utilizing these types of programs. On a recent life insurance company presentation that I was on, most of the structured settlement firms in that group said that less than 3% of their premium received was for attorney fee deferrals, meaning 97% or more was for injury victims. That's typically a $6 billion a year industry. So with that said, there is a huge market of fees that are out there that are not being deferred into the structured settlement annuity or the other programs that are out there. I also did a synergy file search, and it looked like in 2018, only 2% of our total file count was for attorney fee deferrals. In 2019, that went down to 1%. In 2020, it went up to 3%. One of the things I think that happened in 2020 is that attorneys had more time to plan for themselves. Due to the coronavirus, the shutdowns, and the various things, attorneys were actually allowed to spend more time working on their personal planning as opposed to their caseload because of the industry shutdowns. How do you get started? Like we've talked about at the beginning, like I talked about on the last sign, I think planning is critical. I think the easiest way to start is find a consultant that you trust that will walk you through the various programs that are in the space and available to you and your firm. You can utilize your CPA or a tax attorney to work with them and analyze which option is the best for you. The second main part here is communicate with your team. Make sure that they know that on X, Y, and Z case or a future case that you're considering this, and make sure that you have all of the appropriate documentation in place well ahead of a case settling. Once you've done that, commit to starting the program. Over 70% of our clients have done more than one deferral. I cannot reiterate that enough. Once you do this, you are more likely to do more and create a more sound retirement plan for yourself by duplicating and increasing the amount that is going into that retirement plan for you through the attorney fee deferral services. I wanted to end the presentation with some frequently asked questions when I consult with attorneys across the country. The most common question I get is, do I have to do all of my fee? The answer to that is simply no. You can do all of your fee, but it is not a requirement. You can do part, full, or zero of any fee that you have. You can also use multiple products inside of one fee, meaning you can do a traditional structured settlement annuity and an alternative product. You can also do different products on different cases. So there's really no limit on the planning side of setting this up. Another common question we see is, does my client need to know about my fee deferral? The simple answer is yes. Your client typically will know when you are deferring your fee because they are usually required to complete some sort of documentation or execute an agreement where the fee deferral is listed. A lot of time, attorneys want to know if they have to actually do a set amount each calendar year once they start the program. The program is pretty flexible. You typically will defer an independent amount on each case. You can go years without deferring and defer again. You can defer multiple cases during a calendar year. There's no requirement, and you're not setting any sort of guideline for yourself to defer future cases when you make a deferral the first time. This question sounds kind of morbid, but it is one that I get almost every time I talk to an attorney. What happens if I die? Most of these are contractual based obligations. If you do an annuity, you will have a beneficiary listed in the contract, which you can change throughout the course of the payment. If you do an alternative product, they have similar mechanisms to list a beneficiary that would receive the payment in your absence. A lot of times attorneys will call me 2 years into a program and ask me if they can change the payment schedule on their program. The simple answer is no. When you have a traditional structured settlement annuity, the payment schedule is set in the release and those payments are required to be followed. So you cannot accelerate or decelerate the payments in that program. In the alternative deferred compensation programs, they do have a little bit more flexibility, but it is not something that you should plan around. This question is similar to the last one. Can I change the allocation after the plan is set up? With a traditional structured settlement, you are in a fixed annuity. That is what creates the interest rate risk. You are set at the rate when the plan is established, and that cannot be changed. With the deferred compensation type programs, you do have some flexibility in changing the allocation of the program. More often than not, it's limited to a number of changes in a month or a calendar year, but you are able to actually change your investment plan throughout the course of some of those programs. Are there tax attorneys in this field? This is a question we get a lot of times. There are several tax attorneys that work on a national level that you can consult with and decide what option works best for you. They are typically familiar with all of the products and services in this space, and we work with them several times a year and refer cases to them where attorneys want to have a second layer of support with specialization in tax. Do I need to work with the carrier or insurance company paying the claim? The answer to this is the cleanest way to do this is through the defense funding the plan that you select and documenting it in the release for you. Typically, the defense is familiar with attorney fee deferral programs, especially the traditional structured settlement route. They are familiar with it through their work with your clients. They know how to insert this language in the release and the qualified assignment, and they will typically draft a separate check to fund your structured settlement deferral. In full disclosure, this is not a common question that I get, but I do like to set the expectations with everybody involved. How much paperwork is involved in getting this started? Every product or service in this space requires documentation. So there is going to be additional paperwork that you would not typically fill out if you were not deferring a fee. This paperwork is required by all the providers, and it sets in motion the deferral process. Before we start the Q&A, I want to tell you a little bit about myself. My name is Anthony Prieto. I'm a certified financial planner. I am a founding partner and the president of Synergy Settlement Services. Throughout the last 25 years, I've been able to help hundreds, even thousands of families who are receiving settlement funds through the hard work that you all do for them. It's truly an honor that we are able to help so many families. We know they all each have a unique situation and a circumstance, and we hope that the experience and credentials we have here at Synergy helps them create a better future. I hope you guys enjoyed the presentation. So I'm going to walk through a couple of the questions that we've gotten so far, and if there's any more, just feel free to type them in to the question section on the GoToWebinar. So the first one I got was a little bit broad. Any insight on the tax changes that are coming with the new president in office? The only thing that we've been able to do is sort of look at what Biden's tax plans have been throughout his run for presidency and what he's been saying throughout the time he's been in office, this, the last few months. Essentially, what he has been pretty set and standard on when he talks about this stuff is that he is going to increase taxes on people earning over $400,000 a year. So I think right now the highest tax rate is about 35%. I would imagine that that is going to go back to the older rates, which were typically closer to 39%. So on amounts when they hit that grid in the tax bracket, that gets you to the highest amount, whether you're single or paying or filing jointly. That will probably go up about 4% in the future when that tax passes. The second question I just got was, how long can I defer? In these programs, they all have a little bit different limitations, but in a traditional program, most of the times we can find a life insurance company that will allow you to defer your fee through the traditional structured settlement in up to 20 years, meaning you could take a fee in 2021 and not take your first payment for 20 years, which would be 2041. So you can get a long deferral in those programs. The same with the alternative programs. Typically, they've got a limit on the first payment coming in, but they'll have a mechanism that will allow you to defer that first payment out for probably about the same time frame. So I think it's safe to assume that you can defer out up to 20 years. So in situations like this where there's going to be a 3 to 4 year increase in a benefit, you can push your payment out past that start date in the hopes that you'll receive those payments in a lower tax year. I don't see any other questions popping up here. So at this point, I want to thank you all for your time, for listening in. I know this is a little bit more broad attorney fee deferral webinar than we've done in the past. We have some more granular ones available to you through our YouTube channel. So feel free to email myself or Synergy in general and reach out to us if you'd like some additional information.